Every Canadian investor eventually faces this decision. Do you spend years researching individual stocks, trying to guess which companies will outperform? Or do you take a simple route, buy one ETF that gives you exposure to the entire Canadian market, and let the economy itself do the heavy lifting? That's where XIC, the iShares Core S&P TSX Capped Composite Index ETF comes in. It's not flashy, it's not trendy, but it's one of the most powerful tools that Canadian investors have. With XIC, you don't own just a few companies. You own hundreds of them. Banks, energy, telecoms, industrials, consumer staples, and even small caps. It's Canada in a single ticker. But here's the real question. Is XIC truly the ultimate Canadian ETF? Or are there better options for your portfolio? Stick around because by the end of this video, you will know exactly what XIC offers, what it doesn't, and whether it deserves a permanent spot in your RRSP, TFSA, or taxable account. Here's why XIC matters. You're watching this because you care about long-term investing, obviously. You want something simple, low-cost, and reliable. An ETF that you can hold, buy, and let compound for decades without constantly tinkering. And this is exactly what XIC is designed for. It's a core building block for Canadian investors who want exposure to the domestic market. And here's why it matters. Canada's economy is still dominated by financials and energy. But smaller sectors like industrials, tech, and consumer staples are very slowly but steadily growing. Dividend-paying companies remain a cornerstone of Canadian wealth building. And with interest rates finally stabilizing, Canadian equities are positioned to deliver steady returns. XIC gives you access to all of this in just one ETF. It's not just about owning stocks, it's about owning the entire Canadian economy. So what is XIC? XIC tracks the S&P TSX Capped Composite Index, which represents about 95% or so of the Canadian equity market. That means you're not just buying big names, like RBC and TD, you're buying the entire ecosystem. Inside XIC, you'll find the backbone of Canada's financial systems with banks like RBC, TD, Scotia, BMO, and CIBC. And you will also see energy giants such as Enbridge, Suncor, and Canadian Natural Resources, telecom leaders like Bell, TELUS, and Rogers, as well as industrial and utilities such as Fortis and Brookfield that provide infrastructure and essential services. And yes, there is consumer and tech exposure through companies like Shopify, Loblaws, and Magna. In total, XIC holds more than 200 companies, making it one of the most diversified Canadian ETFs out there. Think of it this way. If Canada grows, XIC grows. I think it's really that simple. Now let's look at the upside of XIC. XIC's strengths are very clear. It's a ultra low cost with a management fee of around 0.06%, making it one of the cheapest ways to invest in Canada. It offers very broad diversification among industries, covering large, mid, and small cap stocks, not just the big names you hear all the time. It's very liquid, trading on the TSX with very strong volume day to day. So buying and selling is incredibly easy. And because Canada is a dividend-heavy market, XIC actually passes those payouts directly to investors. Above all, it's very simple. One ETF, one ticker, instant exposure. For investors who want to set and forget kind of Canadian holding, XIC is very hard to beat. But it's not without downsides, of course. There is always a trade-off. Canada's market is heavily tilted towards financials and energy, as I mentioned earlier, which means less exposure to tech and healthcare companies compared to the US or global markets. Shopify, of course, everyone knows about it, and it's a standout in tech, but beyond that, Canada doesn't really have many global giants. It might change in the future. XIC is also a domestic only, so if Canada struggles, your portfolio does as well. And because it's a capped index, no single company can dominate the fund. That's amazing for diversification, but it limits upside from runaway winners. Bottom line, XIC is excellent for Canadian exposure, but most investors, in my opinion, will want to pair it with a global ETF for balance, or an S&P 500 tracking ETF like VFV. Let's give you an example. So imagine two investors. Sarah, who invests only in XIC, and Daniel, who invests in XIC plus a global ETF like XEQT or VGRO. So when oil prices surge, Sarah's portfolio jumps and everyone is super happy. But when energy struggles, the next year or a few years from now, she really feels that pain. Daniel, with global diversification, has a smoother ride. This shows why XIC is very powerful, but not complete. It's best used as a core Canadian piece of a bigger portfolio, not the entire portfolio. Let's talk about the fees now. XIC's management fee is around 0.06%, which is one of the lowest on TSX. Compare that to actively managed mutual funds, which often charge 2% or more. Over decades, the difference compounds into tens of thousands of dollars saved. Even compared to other ETFs that also charge MER, XIC is competitive. It's designed to be a cost-efficient core holding. Anyways, who do you think should choose XIC? In my opinion, XIC is ideal for investors who want broad Canadian exposure, all in one ETF, and who believe in the long-term strength of Canada's banks, energy, and dividend stocks, as well as those planning to pair it with a global ETF or a US ETF for better diversification. It's also perfect for people who value simplicity and don't want to pick individual Canadian stocks. If you want to, quote-unquote, own Canada without overthinking it, XIC is the way to go. To summarize, in my opinion, XIC is one of the simplest, cheapest, and most diversified ways to invest in Canada. By no means is it perfect. Sector concentration and lack of global exposure are real drawbacks here. But as a core Canadian ETF, it's very hard to beat. Think of XIC as your Canada anchor. Pair it with a global equities ETF, and you've got a portfolio built to last decades. Anyways, guys, thank you for watching, and if you found this breakdown helpful, hit that subscribe button. It tells YouTube my videos are at least halfway watchable, and honestly, that's all I'm aiming for. And remember, this is not financial advice. I'm here to give you information, not tell you what to do or what to buy. Anyways, thanks once again, and I'll see you in the next one. Take care.